U.S. mortgage rates dropped last week by the most since February. That's according to data from the Mortgage Bankers Association. The rate on the 15-year mortgage fell below 6% for the first time in 4 months, matching its lowest level since October. The news comes as government data showed shelter costs continued to decelerate in July, though they still outpace overall inflation. Joining me now, Danielle, Hale, Realtor.com chief economist and Yahoo Finance senior housing reporter Claire Boston. Before we sort of dig into the shelter costs broadly, Claire, I do want to start with you just on this Mortgage Bankers, the latest rate news that it is coming down. I imagine this is welcome news for folks who are trying to move, since we have seen those rates so persistently high.
Yeah, Julie, anything really helps here, since we've pretty much been stuck at this kind of high 6% space for pretty much all of this year. That being said, when I'm looking at this MBA application data, what sticks out to me is that we have not really seen an uptick in purchases yet. So, that suggests to me, people who are sitting on the sidelines are not jumping back in with rates a little bit lower. We are seeing refis tick up quite a bit, though. So, maybe if you have a 7% or higher mortgage rate, getting a little bit of a drop here is going to entice you to refi, but we'll see kind of what happens in the coming weeks.
Really, shelter has been sticky, as economists like to call it. Those shelter costs, even if they're moderating, they've just been sort of persistent here. Claire, what do we see in the numbers for last month?
Definitely. So we are still seeing shelter inflation run quite a bit hotter than general inflation. It is coming down. This is kind of the lowest year-over-year print since, I believe, October of 2021. That being said, housing costs are still rising. And, I think that we talk a lot about affordability. A lot of both renters and potential buyers are still feeling stretched, and, their incomes may not be keeping up right now with their housing costs.
So Danielle, let's bring you into this. Why has this been happening? Why are these costs? Why is that shelter inflation so sticky and so persistent?
Well, we had a huge run up in prices during the pandemic, especially in rents, which really soared. They've softened recently, at least on the asking rent side of things. But if you look at rents more broadly across the economy, so for renters who might be staying in place and renewing, they are in many cases still playing catch up to those significant increases that we saw during the pandemic. So that's why shelter inflation costs tend to lag market rents. The good news is that market rents have actually softened again. Our rental report shows that we've had 24 consecutive months of rent softening as of July, and the rents were down 2.7% on a year-over-year basis. So it's a bit of a discount, but again, this is just asking rents. And so what we're seeing in those broader trends when we examine the data for all rental units is not quite as much softness yet, but we do expect to see that on the horizon. Now, one sort of caveat or warning is that with the trade uncertainty that we've seen and the softness that we're seeing in rental data, we're starting to see multifamily construction slow, at least on permits and completions. And so that means that the softness may not last, but it is there. And I do think that's going to help bring inflation down as we look in the months ahead. But then we do have this wild card of tariffs, which could lead to some opposite findings.
Yes, we do. I mean, and in terms of how people feel about it, they definitely feel that things are unaffordable. Claire, we did a Yahoo Finance poll recently that sort of dug into that idea of affordability.
Yeah, I mean, in general, most people are saying that they really feel like the housing market is out of reach for them, at current prices, especially when we look at the purchase side. Home prices, depending on your metro area, are up anywhere from 15 to 50%, from those pre-pandemic levels. And that makes it really difficult to, get into this market. It's not just purchase price. It's also that, that 6.7% mortgage, that really cuts into your buying power right now.
So we've been talking about sort of renting versus owning. Danielle, what's the percentage, I'm curious, of the U.S. that is renting versus owning a home? And what are the relative merits right now, given the cost of each?
Right, so it's roughly 65% to 35%. And we have seen homeownership rates soften because of these high costs that Claire were talking about, not just the purchase price, but also the mortgage rate. And earlier we were talking about mortgage rates coming down. It is good to see this movement lower, but it's worth putting it in context. Being at the lowest in 4 levels still means we're up above 6.5%, and still means we're looking at mortgage rates that are significantly above where they were during the pandemic. So those costs really haven't adjusted. If we look at for younger households, so those are those households that are likely to be most flexible between renting and owning, or on the fence between renting and choosing to buy a home, that's where we've seen homeownership rates slip the most. And that's a signal of just how challenging the for sale market is, and also a sign that we're seeing some relief in the rental market. In June, we took a look at rental costs versus buying costs and found that if you're looking just at the simple monthly cost basis, the majority of the largest metros, all except one actually, were tipped in favor of renting right now. So the short-term financial incentives are very much in favor of renting. But for those who are going to be in their home for a longer time and are thinking over that longer term horizon, it might make more financial sense to buy, but you've really got to invest and be planning to stay put for a longer time in order for that to make financial sense.
And you alluded to tariffs before, Danielle, and whether you're renting or buying, you've got tariffs affecting construction costs, supply costs, et cetera. We've been trying to figure out how tariffs are affecting everything, right? And on what timeline. How should we be thinking about it with housing costs?
Yeah, so it's not something that we're going to see right away. But in our recent rental report, we took a look at the areas where we're seeing the biggest slowdown in multifamily permitting activity. So that's one sign that maybe some of the softness in rents and tariffs in general have affected builders' appetites to continue building multifamily properties, which are typically going to become rental units. And the timeline for that is usually a couple years out. So we found that in some metro areas that usually see a big run up in permitting activity from the first quarter to the second quarter, we actually saw significant declines in rental activity. So that does suggest we are seeing some builders react to market conditions and are seeing some slowing in specific areas. Some of the markets where we saw this is in Philadelphia, as well as Orlando and San Diego.
Claire, Danielle, thank you so much. Lots of interesting info here for those who are trying to figure out their next move. Appreciate it.
Thank you.
Thanks for having me.